We're taking a look at LB Finance today. It's a story of some really impressive growth, but the real question is, what's fueling it and at what cost?
Because on one hand, you see a 25% jump in profit, and that looks fantastic. But then you see it right next to a 122% explosion in bank debt. And you have to stop and ask, what is actually going on with this business model?
All right, just a quick but important disclaimer before we go any further. This presentation reflects my personal views and is for informational purposes only. It does not constitute financial advice. You'll notice certain figures are shown as adjusted data. These are from my own models. And for full transparency, I do hold a financial interest in LB Finance PLC.
Okay, let's start by unpacking that profit number and see what's really happening with their margins.
So, the headline figure looks great. We're talking 9 billion rupees in profit over just 9 months. That's a solid 25% jump from last year. And you know, a number like that, it definitely gets people's attention.
But here's where things start to get interesting. Look at this. Their loan book absolutely exploded by 51%. Huge growth. But the income they made from all that new lending, their net interest income, only went up by 17%. See that gap? That's a massive disconnect.
So what does that gap mean? Well, it's something called net interest margin compression. In simple terms, for every single new loan they're writing, they're actually making less profit. Their core business engine is getting squeezed. Now, it's not all bad news on the efficiency front. To be fair, they are controlling costs pretty well. You can see their revenue grew by 26%, but their operating expenses only went up by 16%. So they're definitely getting some good operational leverage there. That's a plus. All right, so that brings us to the big question, right? Where did the money come from to fund all this growth?
How on earth did they fund an extra $102.5 billion in new lending?
Well, let's look at the numbers. It certainly didn't all come from their customers. See, their deposits, the stable, reliable money you and I put in, grew by a pretty healthy 26%. But their lending grew at double that speed, over 51%. And that creates a huge funding gap. And what happens when you have a gap like that? You get this number, a loan-to-deposit ratio of almost 173%. Think about what that means. For every 100 rupees the company holds in stable customer deposits, it is lent out nearly 173 rupees.
Now, this LDR, or loan-to-deposit ratio, is a really important number for any financial institution. It basically tells you how much of their stable funding is already out the door as loans. And when you see an LDR this high, it's a huge red flag that they're relying on less stable, what we call wholesale funding, to grow.
So, let's dig into that. How exactly are they plugging this widening funding gap?
And here's your answer. They started borrowing a lot from other banks. Their due-to-banks line item just skyrocketed by 122%, hitting almost 84 billion rupees. That's where the money for all that growth came from. Okay. So why should you care about this? Why does this matter so much? Because this type of funding, borrowing from other banks, is just way riskier. It's often very short-term, it's super sensitive to interest rate spikes, and probably most important, it's not sticky like our deposits are. If there's even a hint of a crisis, that money can vanish literally overnight.
So pulling this all together, what can we learn from this? Well, there are 3 really key lessons here.
First, don't just look at the profit. You have to watch that loan-to-deposit ratio. It tells you the real story about funding risk. Second, keep an eye on fee income. That huge 74% surge we saw, it's great confirmation that they really are originating a ton of new loans. But if you ever see that number start to slow down, that's your earliest warning sign that the growth machine might be in trouble. And third, and this is a big one, is something called vintage risk. Look, when you grow that fast, over 100 billion in just 9 months, you have to wonder if you lowered your standards to get there. The problem is, you won't know for sure for another 12, maybe 18 months when we start to see if those new loans are actually getting paid back.
So what's the bottom line here? lFIN is playing a high-growth, high-leverage game, and right now it's working. Profitability is strong, cash generation is strong. But, and this is the crucial but, their entire liquidity profile has tightened. A lot. This is a strategy that's really only suitable for growth-oriented investors who understand and are comfortable with that much higher level of funding risk.
Look, if you found this deep dive valuable, connecting the dots between the profit statement and the balance sheet to find the real story, then do me a favor and subscribe. We're going to be doing a lot more of these.